Good morning. Jagender Rana here. Topic of the day is rating methodology of insurance companies. Rating methodology of insurance companies. You must have heard the name of CARE, CAR. This is one of the rating agencies. The CARE's claim paying ability rating is an opinion on an insurance company's financial strength and measures its ability to honor policy claims as per contractual commitments. The opinion is not specific to any particular insurance policy or contract. The CARE CPA rating does not apply to non-policy obligations of the insurer, such as debt, nor does it address the suitability of terms of any individual policy or contracts. Additionally, the rating does not take into account deductible surrenders or cancellation penalties, timeliness of payments, nor the likelihood of the use of defense like fraud or denial of claims. So the rating does not take into account any intimation that the insurers might face in settling its foreign claims due to exchange control or sovereign restrictions that might be placed on foreign currency payments by the government of India. CARE CPA rating is not a recommendation to you to buy, hold, or sell, terminate any security or insurance policy. Let's see what are the benefits of CPA rating. CPA rating is primarily useful to buyers of insurance cover. It aids existing as well as potential customers to evaluate the insurer's ability to service policy commitment as and when claim arises. Insurance and reinsurance companies, because it helps the company in showcasing its financial strength and consequently increase its business opportunities. So an independent opinion on financial strength also provides critical inputs for management. And for insurance agents, it aids in selling insurance products. As far as methodology is concerned, CARE CPA rating analysis begins by a review of the economy and the industry in which the insurance company operates. So the nature of insurance regulation and the competitive position of the company are also examined. So CARE ratings then applies the Ramels framework, RAMELS, Ramels framework, to assess the financial strength of the subject insurance company. No one factor is considered in isolation, but all factors are viewed in conjunction before assigning a rating. So this Ramels factor or Ramels framework stands for R, risk underwriting, A, asset quality, M, management, E, earnings, L, liquidity, and S, solvency margin. So a detailed methodology based on the Ramels framework is given. Risk underwriting, R. So the analysis of risk underwriting constitutes the key element in a CPA rating assessment and plays a vital role in the final outcome of the rating assigned. The efficiency of a firm's underwriting strength is brought out by its historical claims experience, degree of diversification in risk underwriting, and the relative growth in business volumes. Care Ratings also evaluates the policy of pricing of insurance products, mix of tariff and non-tariff businesses, proportion of long-tail business as well as the exposure to lumpy risks such as catastrophe covers. Each business segment of the insurer is analyzed in depth with an emphasis on understanding its unique competitive characteristics that will drive future earnings potential or cause deterioration in financial strength. So following factors are considered while analyzing the business segment of the insurer: market share, geographical spread, diversity of the risk underwritten, pricing policy, underwriting expertise, competitive advantages, mix of tariff and non-tariff products, product innovation, proportion of long-tail business, and claim experience and exposure to lumpy risks such as catastrophe covers. Now, a quantitative and qualitative assessment of the above factors is carried out by analyzing the trends in premium income, reinsurance ceded, claims experience, and expenses incurred on reinsurance business over 5 years time span. So apart from the above, Care Rating also assesses the current as well as potential underwriting capacity by analyzing the firm's operating coverage. Care Ratings also examines the insurer's reinsurance program, terms of reinsurance, financial strength of reinsurers, and the company's processes employed to monitor, collect, and settle outstanding reinsurance receivables. Then asset quality. Claims paying ability of an insurer could be hampered by future losses on its investment portfolio. In respect of insurance entities, assets quality assumes a greater dimension as it influences not only the level of income but also has a direct bearing on the insurer's ability to provide instant liquidity. Insurance entities are susceptible to credit as well as market risk on their assets portfolio, similar to banks. In this regard, Care Rating analyzes the quality and diversification of assets across various classes, as most of the assets deployment decisions are largely guided by certain regulatory constraints. Care Rating reviews the insurer's level of adherence to regulatory norms and assesses its performance under the specified constraints. Care Ratings also measures the degree of success of the asset deployment strategy vis-a-vis the selected goals of maintaining a fair degree of liquidity, yield optimization, and capital protection. So in this context, Care Ratings broadly examines factors such as investment philosophy and strategy vis-a-vis the insurer's risk profile, portfolio diversification, credit quality of the investments, level of non-performing investments and its NPA recognition norms, adequacy of provisioning, and liquidity of the investment portfolio. The next one is management. So the management quality is a very important qualitative aspect which can make a substantial difference to a company's performance. Insurers must be able to demonstrate that they are a growing profitable business with a staying power. In this context, Care Rating looks at the management goals, mission, philosophy, etc., and reviews the corporate strategy laid down to achieve the stated goals. Care's term undertakes discussions with key executives to understand the insurance company's perspective on the strategies and plans designed to counter environmental challenges from all fronts. Thus, experience and depth of management to tide over periods of crisis is recognized as a favorable attribute. Care Rating also examines the financial strength and track record of the promoters, The degree of group support enjoyed particularly at times of stress, nature of business plans, and targets. So experience of key executives manning important positions and the degree of technology of orientation. A strong parentage and group support is viewed favorable by care ratings and is examined with respect to past proven support and assurances of future support. The next one is earnings. So the profitable operations are necessary for insurance companies to operate as a growing concern. CARE's measurement of earnings focuses on an insurer's ability to efficiently translate its strategies and competitive strengths into growth opportunities and sustainable profit margins. The CARE ratings analyzes the profitability of the underwriting and investment functions separately. And underwriting performance. The underwriting profitability is impacted by the level of premium income, agency commission, staff cost, and claim experience. Following ratios are analyzed to gauge the underwriting performance of the insurer. Rating methodology. Premium growth, risk retention, loss ratio, expense ratio, combined ratio, and investment yield. And performance of investment operations. Investment income is largely a function of the investment strategy followed by the company. The behavior of the securities market and interest rate movements also influence the return on the investment portfolio. CARE ratings examines the following to assess the performance of investment operations in terms of investment yield, market risk, and its probable impact on earning is also examined. Then overall profitability. CARE ratings analyzes the level and trend of the below mentioned ratios to assess the overall profitability of the insurer. These ratios are analyzed over the past few years and compared with the industry peers, and these are net earning ratio and return on net worth. Then liquidity. Good liquidity helps an insurance company to meet policyholders' obligations promptly. An insurer's liquidity depends upon the degree to which it can satisfy its financial obligations by holding cash and investments that are sound, diversified, and liquid, or through operating cash flow. So a high degree of liquidity enables an insurer to meet the unexpected cash requirements without untimely sale of investments, which may result in substantial realized losses due to temporary market conditions and or tax consequences. Some of the ratios examined by CARE rating for assessing the liquidity of an insurer include liquidity assets, which is technical services, liquidity assets to current liabilities, operating cash flows. So while analyzing the insurer's liquidity, CARE rating would critically examine the asset liability maturity profile of the insurer. CARE rating would also examine the impact of a stress test on the LM to understand the shock absorbing capacity in the event of an unforeseen loss of confidence, sudden catastrophe losses, or wide fluctuations in the security markets. Then solvency. So adequacy of solvency margin forms the basic foundation for meeting policyholders' obligations. All insurance companies are required to comply with solvency margin requirements of the regulator. CARE rating further analyzes the impact of changes in key variables in solvency margin to ascertain the strength of the insurer. Apart from the above, CARE rating ratio assesses the current as well as potential underwriting capacity through an analysis of a firm's operating leverage. So CARE rating would study the reserving policy of the insurer and would examine the claims experience vis-a-vis the reserves created. This is the reserving policy. The shortfall in reserves, if any, would then be compared with the insurer's net worth. Apart from relying on regulatory guidance on prescribed solvency levels, care rating would assess the capital adequacy of the insurer. Care rating believes that the capital adequacy addresses the impact of all dimensions of risk in the long term and therefore helps in arriving at a realistic level of risk. So, rating of insurance hybrids. In 2015, IRDAI released guidelines on issue of other forms of capital for Indian insurance companies. Under this, insurance companies were allowed to raise capital through issuance of preference shares of subordinated debt to improve their solvency position. So the subordinated debt issued by insurance companies has some unique features which are given due considerations while rating. The rating of the subordinated debt of an insurance company takes into consideration its increased sensitivity to the insurer's solvency position and profitability during the tenure of the instruments. The rating factors in the additional risk arising due to the following key features of the instrument. Servicing of interest is conditional or company maintaining a solvency above the levels stipulated by a regulator. In case of the insurance company reporting a net loss or if the payment of coupon on the subordinate debt is expected to result in a net loss, the company requires obtaining a prior approval of the regulator for coupon payment on such subdebts. Any delay in payment of coupon principal, as the case may be, would constitute an event of default as per care rating definition of default, and as such these instruments may exhibit a somewhat sharper migration of the rating compared to the claims paying ability rating. Given these additional risks, subordinated debt of insurance company is generally notched down by at least one notch from its claim paying ability rating. So this is all about the care rating. Thank you very much.